Good morning. You're watching The Market right here on 89 with me, Asha Faridi, Nikunj, Dalmia, Bhasin in the studios. And what a turnaround really from the markets. Well, yesterday, of course, we managed to close in at the session lows, breach that 21,500 level, and then from there saw just a minute bit of recovery. But this morning, it's a completely different setup. You've got all of Asia holding up very smartly, and the GIFT Nifty already indicating a gap up start of nearly about 130 points as we speak right now, so indicating that there is a rebound finally in store.
So Aisha, just when it appeared that the markets were getting into that uneasy zone, at least both for our markets and so and for global markets, I guess globally we've got a leg up this morning, and crude is down, Nasdaq is up. Nasdaq maybe 9% away from an all-time high, but S&P is almost at a fresh YTD high. It is only 1.2% away from an all-time high. But if you just superimpose this graphic with what Indian markets are doing or what Indian markets have done, Indian markets in a sense in last couple of days, from the YTD high, Nifty is down 2%, Nasdaq small cap index is down 1%, and the mid cap index is down 1.5%. So there could be a bit of a local versus global flavor which could be at play, because suddenly there is a big comeback by global markets. Yields have hit a pause button and crude seems to be declining. Now, when you typically see global strength and when you are coming off a rather numb patch, so to speak, in the global markets, then global markets could occupy center stage. So the narrative for next couple of days could be more global and less global. Now let's look at local markets. What did we see? We've gone, and I'm really talking about the short term here. I guess the Santa rally hangover is over. The markets have realized that 1 week into the trade, everyone is realizing that the last quarter phenomenon in terms of price action momentum is unlikely to continue this week. Then you look at the market positioning. The market positioning is such that we've managed to crawl back to the lower end of the Nifty. And if you've gone to the lower end of the Nifty, then in the near term, that becomes this testing zone. So, courtesy global cues, will markets bounce from the support level, or Indian markets in the near term, after the kind of monster rally we've seen in November and December, they may just underperform. So the hangover is over. The momentum in a sense has not spilled over from December to January, and now everyone is suddenly talking about that, okay, we want to be a buyer, but we want to be a buyer on decline. So are we reaching that point yet? But one trade which is for sure is buy higher and sell higher. I think that trade is over.
Yeah, absolutely. And you know, the texture of losers yesterday, you had Reliance, you had HDFC Bank, which have been non-performers all through last year. They were the ones which were dragging, and ICICI Bank and SBI, extremely sharp corrections on both those names.
Yeah, yesterday's price action was not very satisfactory, frankly. And if global cues would have not been strong and supportive, we could have.
We would be discussing completely different things this morning.
Exactly.
Yeah.
So now what you got to, if you take the leaf out from what the setup is, and if you look at all the ingredients in the melting pot, will we go with the global trend, or are we likely to go against the global trend? The spillover effect of momentum is not there, and are we likely to find support at lower levels? My sense is that you need to be a buyer on bad days. Like, when you see a little bit of global panic, you near the Nifty support levels, you just go below the support level, you want to be a buyer. But you do not want to chase stocks what you did, let's say November and December. That may not be a very gratifying experience.
Okay, perhaps that could be the strategy that you look to adopt as of now. And just to elaborate a little bit more on the global cues, yes, indeed, it was a healthy handover coming in. A lot of the tech-heavy stocks rallied. Nvidia, for instance, was at an all-time high. The Nasdaq jumped about 2.2%. And across the board, you did see a smart gain coming in for Wall Street. And this morning, it seems like the Asian markets as well have risen across the board, rebounding from yesterday's sell-off. You have a lot of macroeconomic data as well that will be anticipated. But that aside, then, let's also put the spotlight on the December AMFI data that has come out, and indicative of the fact that there have been strong inflows in small and mid caps, and 12 straight month, Nikunj, that you're seeing a robust trend coming in particular for the mid and small caps.
I used to always feel happy that SIPs are going higher, and that's like really been the hallmark of this bull market. So we're not saying anything. 17,000 crore on a gross basis, I think, is a very enviable number. And typically when you see markets giving you a appreciation on a daily basis. Whether you're a retail or institutional investor, no one's going to sell. Now, where I would like to draw a red flag is stay with this graphic. Flows into small cap funds in the December data, they are indicating that they were at 4,000 crores. So out of the 17,000 crore, 4,000 crore, that's what? Almost 20% of the flows have gone into small cap funds. Now, the data also seems to be indicating that money is moving out of debt and moving into equities. So I don't want to make a case that you need to cancel your small cap SIPs, or you need to perhaps take a complete different approach when it comes to investing in the small cap and the mid cap funds. I'm using the word funds here consciously, not stocks. But somewhere I think risk management is required now, because if everybody is chasing small cap funds with the assumption that we would be in for a repeat of 2023 and 2024, I think you need to exercise some caution. So keep your expectations low. If this kind of a robustness into small and mid cap flows continues, then you really could be having a lot of money chasing few quality stocks. So I think AMCs now really need to take a call that is there margin of safety and is there value in small and mid cap stocks. If it is not, I think they should go out and take a call that okay, we should stop inflows into some of these schemes. Some schemes have started that, but I think the industry now really needs to take a holistic approach. You cannot have a situation where such flows come into small and mid cap stocks, and you actually have a situation where there are very few good stocks and a lot of money, and money is moving out of debt into small cap funds. So it's the flow of money which in a sense will ensure that the market valuation will go out of sync.
All right, that aside, let's shift gears and find out what exactly the global commentary is indicating. Then we've got Vinny here to sum it all up for us. And Vinny, a lot of talk on inflation.
Absolutely, a lot of talk on inflation, and this time seems a bit on the positive side. Firstly, we have commentary that is coming from Bowman, Fed's Bowman, who's highlighting that in terms of inflation, if the inflation continues to fall towards the 2% mark and target which the Fed has set, then obviously eventually there'll be a time when they will be starting to actually start reducing the rates as well. There will be rate cuts going forward as well, and obviously in terms of policy will be becoming overly restrictive as well. But yes, possibility that now rates are overall the target for inflation is coming down and nearing the 2% mark. So a bit of a positive sign there, and that's the similar commentary we've seen coming in from Federal Reserve Bank's Atlanta President Bostic as well, who's saying that inflation has come down and it's coming down at a faster rate than he was expecting as well. So yes, keeping an eye out on that overall. They said that yes, it's too early to declare victory, but yes, something to watch out for there. Lastly, commentary that we've seen coming in from Peter Schiff as well, and he's highlighting in his tweet that not only did the Fed slow down the quantitative easing, but is likely to actually pivot back to the quantitative tightening and coming back to the quantitative easing front is what he's highlighting. This means that the Fed's progress on inflation will not only be reversed, he's highlighting, but the annual CPI gains will yet hit a new YOY high, is what the highlight is coming in from him.
Okay, Vinny, we'll leave it at that. Let's welcome on board Kunal and Nooresh and figure out what the technicals of the markets are indicating. Kunal, Nooresh, hi, morning. Kunal, yesterday when we were sinking away in the latter part, we were talking about as to how you actually foresee a good 500 to 700 point fall further from here on the index alone. This morning, the global cues seem to be a completely reverse picture.
Good morning, Aisha. So yeah, I think after a 250 point kind of a correction on the index, we're seeing a bit of a bounce on the index. Now we'll probably expect that the index, if it breaks past about the 20,700, 750 mark, then we could probably be talking of a possible strong reversal on the upside. But then what happened yesterday in terms of closing basis, we managed to break below a lot of important support points. A lot of indicators turned negative in terms of the trend indicators for the indices, and I think that is one of the major concerns for the markets emerging. So even if we see bounces of this category, we will have to see that whether these bounces are actually good enough to try and convert them into a decent short-term uptrend, and whether we scale past about the previous swing highs and make new highs for the indices. So as of now, it looks like that the indices would probably grind into a bit of a range. We've been stuck into this 300 point range earlier, 21,500 to 21,800 approximately on the Nifty. It seems like that I think we would probably continue to grind a bit more from into this range from the next couple of days perspective. But if we break below that 21,500 mark, I would probably expect that we could probably be seeing another 500 to 700 point cuts on the Nifty.
Nooresh Mirani is also with us. And Nooresh, take us through your views as we were just on the brink of the 21,500 mark in yesterday's trading day. On the back of the fact that we've got a strong handover from Wall Street, is that spelling out good news for us?
So what we are getting into is possibly some bit of a consolidation. We had a good run in the indices across the board, whether it was the large cap or the mid cap indices. So time for a pause. It's just that we've not even broken the recent swing lows. If we start breaking 21,500, sustaining, then we go back and test the 21,000, 21,200 mark, which is the major support in the near term. In the same way, on the upside, we need to break 21,800, 850 levels for a fresh rally. So getting into a range-bound move, we could continue to see stock-specific action, but one will need to be more careful, reduce size because the momentum could reduce going forward.
Okay, let's nail it down to those individual stock calls and find out what our chartists are betting on. Kunal, what are your top picks?
So I'll go with one buy and one sell. The first one is on InfoEdge. The stock is forming a bullish flag formation on the daily charts. It's nearing a breakout about that 5100, 5150 mark for itself on the spot level. So would suggest a buy with a target of 5,500. Stop loss could be kept at 5,000 levels. And HDFC Bank has formed a head and shoulder pattern on the bearish side. So it's almost a 25 to 30 pointer pattern for the stock. So expecting a further down move into the stock. 1625 is the target. Stop loss at 1700.
All right, Nooresh, let's find out what's on your radar, your top recommendations. You're looking at some of the large caps.
So looking at large caps, more low beta names. So first is a buy on Power Grid. The stock has slowly and steadily gone up, hit a new 52-week high and an all-time high. Yet to catch momentum, could catch momentum going forward. So a stop loss at 235, target price of 270. Second is a buy on Bosch Limited. The stock has broken out above the 22,000 levels. The breakout is done. It's making a slow and steady move, expecting this to continue higher steadily. Stop loss at 21,800, target price of 24,000 plus.
Right, okay, let's talk about some of the other stocks which are going to be in focus today. And we've got Zee as well as Bajaj Auto on our radar. Samit is here to flag off both. Samit, happy birthday.
Thank you.
Let's start off with Bajaj Auto. What are the buyback details like?
Well, if you look at the Bajaj Auto buyback, the price of 10,000, now this might excite anyone because it's a premium of 43%, but one needs to understand that the total amount of buyback is just 4,000 crore rupees and the number of shares that they'll be buying back is just 1.4% of the equity, that is close to 40 lakh shares. Now the portion that will be reserved for retail shareholders will be around 15%, which is around 6 lakh shares. But do remember there are nearly 1.5 crore retail shares in the market, and if everyone goes ahead and tenders for this buyback, then the actual acceptance ratio would be just 3.6%, which means that though the buyback price is at a premium of nearly 43%, the actual gains would be just 0.5 to 0.6% for any retail shareholders if they tender for buyback. In simple words, if you tender all the shares for buyback, now generally an investor who has around 28 to 29 shares will be a retail shareholders, and if he tenders all these shares for buyback, then just one share will be accepted by the company for buyback if every one of them go ahead and tender for this buyback. Now, for whom will this buyback be actually beneficial? Now, this buyback would actually be beneficial for those shareholders who have been a part of Bajaj Auto for a very long time. But if anyone is trying to do a trading play here or an arbitrage play here when it comes to the Bajaj Auto buyback, then there won't be any much gains for them in this buyback.
See, why are they doing the buyback? Obviously, they're doing the buyback because they want to send a message out that, look, we think there is value in the stock and we don't want to use that kind of cash. So I agree that, look, this is not like a great arbitrage and it is not like a massive buyback. But a company like Bajaj Auto, this is the second buyback they've done. And there seems to be a big departure in what Bajaj Auto earlier was versus where it is now in terms of pure capital allocation. See, the auto business in India is a very strong cash flow business. And auto companies in the past have really done a lot of dividend buyback. Now, frankly, if you ask me between buyback and a dividend, which is a better option in terms of in tax payout, tax efficient, I think it is buyback which is more tax efficient. See, this is the second buyback they've done in less than 2 years. If you do buyback and if you do a buyback of this size, that typically means that the return ratios will start increasing, and it's a message from the company that they are going to be much more shareholder friendly in terms of allocation. When all IT companies, they started doing buybacks, then first, then it is almost becoming like a routine for them to consider buyback, given that buyback has acted as a strong support in terms of keeping the valuation stable for IT companies. So are we at that level where most of the auto companies could also start considering buyback, largely prompted by Bajaj Auto? And Bajaj Auto is doing a buyback. For me, it is an indication that we are going to be much more shareholder friendly in terms of just giving the money back. So don't go by the size, Somit. That's my view. Don't go by the quantum. Nobody was, they never, this buyback has also come more like a bolt out of the blue. So I would consider this as a bonus rather than something which we should look at the size and analyze it. But for me, the message here is that they want to give cash back to the shareholders and improve on the return ratios.
Okay, that's Bajaj Auto for you. Let's move right on then and talk about the fairly contentious Zee Entertainment. And sources indicate that that merger might be called off. The grace period was extended. And now this news coming in.
Well, yes, what reports are suggesting and sources are suggesting is that Sony is likely to call off the merger with Zee, and most likely they will issue the termination notice by around Jan 28th. That is exactly after the 1 month grace period that they had. Now, if this happens, then it will be actually negative for both the parties, given that both of them have been reporting subpar growth in the last financial year. Also, given the fact that there's a merger talk between Disney and Reliance. So consolidation is happening on the other end, but if these two players are left out on their own, then obviously it will be negative for them. And another thing that what the street is saying is that if this happens, then they'll have to again make a new strategy right from ground zero, which will be a tall task for both the parties going forward. Hence, a merger not going through will net be a lose-lose for both the parties going forward. However, we still need to get a clarity on that front. These are just source-based stories and report-based stories that we are currently getting in. But if actually the merger doesn't go through, then it will be then it will lead to a significant downside when it comes to Zee Entertainment share prices, right?
See, there is consolidation happening in the sector. First, let's qualify, like Somit said, this is complete source-based story. We've not got independent confirmation either from Sony and from Zee. This pure source-based story which has come on global wires. If the merger does not go through in the near term, could that have an impact on the stock price of Zee? Yes, sir. Because the Zee stock in a sense has really been hinging on the fact that there would be a merger and there really could be a change of guard. And the dynamics of the industry are also changing as the consolidation is happening in the sector, both locally and globally. Now, for Zee and Sony as a franchise to come together, then the dynamics for shareholders and the dynamics of the Indian television stroke, the entertainment and the news industry would change. But if the merger does not go through, considering that the sector has gone through a rather painful time in terms of where the growth has actually been, and suddenly tailwinds have become headwinds, I guess in the near term this really could add some more volatility. Is Zee an F&O ban? I think last time I saw it was an F&O ban. Yeah. So just think about it. If it is an F&O ban, the merger will have impact on the stock. It's a highly volatile stock. But before we wrap it, here's a disclosure. The channel you're watching is owned by Bennett & Coleman, which is India's largest media company. So please consider that as a disclosure on our behalf, because we are discussing a media stock.
All right, there you have it, Sumit. Thanks for joining in and have a super birthday as well. Okay, let's tell you what we'll do right now. We'll slip into a very quick break then right here on the show. We've got lots more lined up when we return with our market experts. Thanks for staying with us. This is the market. Now, Bloomberg has proposed adding India FAR bonds in the emerging markets local indices, and this move is very similar by what we saw last year with JP Morgan. Let's get an Anurag Joshi who joins in with the details of Bloomberg's inclusion. Anurag?
Global financial information and news company Bloomberg is seeking feedback from global bond market participants for a proposed inclusion of India's fully accessible route of bonds in its local currency indexes. Now, the proposed inclusion of the India bonds in the Bloomberg indexes is proposed over a 5-month period starting September. And for this, Bloomberg is seeking feedback from market participants. Bloomberg is proposing adding the FAR bonds to its EM local indexes, and Bloomberg's decision to seek feedback follows a similar proposal by JP Morgan in September when it had proposed including India's government bonds in its bond indexes. Now JP Morgan's inclusion of India's government bonds in its indexes kicks off in June this year, and at that time analysts had expected the JP Morgan move to help attract at least $21 billion in India's bond market.
Okay, let's move on and let's welcome on board Sanjiv Bhasin as well and talk about what he's making of the market and of course individual stocks as well. Sanjiv, hi, good morning. Good to have you on the show as always. And what a U-turn the global markets have taken, Sanjiv, especially given the breach of 21,500 yesterday, the kind of correction that played out in some of the blue chip names like Reliance, ICICI Bank, SBI, the way they were falling. One is wondering whether today we're going to choose to follow the global cues. At least going by the GIFT Nifty, it seems to be the case.
Yes, good morning, Aisha. Good morning to you, Awan and Nikunj. And Delhi at 8 degrees is giving me a lot of pleasure in the weather, but discomfort in the early morning summary. So yes, we slept well. And yesterday we had told you 21,500 is going to be retested. And lo and behold, who thought that the Nasdaq will be up 350 points and the Dow is falling, following chase? So I think the short-term bond yield price hike is already getting priced in. You have this positive of Bloomberg also including India in the bond index. And I think banks are raring to go. The results this quarter from the banks will be the trendsetter. So I am extremely positive on banks and some of the other stocks, with the autos and so on. But I think now that, we've had this consolidation stroke correction, 21,500 has been defended. And if we today cross that 21,750, which fingers crossed, I think, then we are headed to past that 22,000, whether we like it or not. And I think the frenzy will see again the left out feeling, seeing buying again, because as you start to scratch 21,700, the money on the sideline will re-enter. So yes, a healthy correction for the market, but now take it with a pinch of salt. If you use this decline to buy, then stay put because we are headed higher.
Okay, so are you betting on banks to buy on decline, Sanjiv? Is that the recommendation?
Yes, Aisha. Firstly, only you just take that if the bond index happens and you get included, State Bank will be laughing its way to the bank. FY23, 50,000 crore. This FY24, they will be coming out with 68,000 crore profit. And next year, you are talking of 80,000 crore. Price to book 1.9 times. 52 lakh crore balance sheet, 7 lakh crore housing loan. How can you go wrong? And State Bank has done actually nothing. PNB was 50 and State Bank was 600 and State Bank is 630 and PNB is 100. So if I have to put one stock in my large cap list, which is giving me extreme safety for a target of 750, it is State Bank. Secondly, look at the numbers from Maruti. 230,000 retail sales in the month of December, which is arguably the most weak month, given that people want to get rid of inventory. And they are saying this is the highest in the history of the company. So at 10,000 rupees, Maruti is giving a screaming buy for a target of 10,500. And last but not least, Indus Tower. In this whole Vodafone's game, which is going on for capital infusion, it is now evident that Vodafone has survived. And now with Grasim putting in money into Vodafone, Vodafone itself may come out with the rights. Indus Tower will be the one which is laughing its way to the bank because receivables come, ARR and IRR both will improve. And we know that tower business, they are the market leader with a 53% market share. So these three stocks are on top of my buying list.
All right, stay with us. Lots more to chat about. And Tata Motors in the spotlight as JLR has delivered strong sales in the third quarter of FY24. Although it's missed street estimates, let's understand a little bit more about the Q3 updates. We've got Shrishti here with the details. Shrishti?
Well, yes, Tata Motors JLR is in focus as the company has come out with its Q3 updates where the numbers look pretty decent, wherein the wholesales data that has seen a jump of 4% on a quarter-on-quarter basis, while the retail sales has seen a jump of 2%. The numbers are slightly below what the street was expecting in, but what's strange to note is that this time the company didn't come out with its free cash flow number that they are expecting at the end of Q3, wherein earlier we have seen companies coming out with a commentary which was a big trigger for the stock as well. Talking about the other data, that is their order book trajectory that is seen to be declining on the expected lines, with the chip shortage seen to be improving. Their order book is eventually coming down, and this time that has come down to 148,000 units from 168,000 units in Q2 FY24. Other than that, onto their order book number, the company too mentions that 76% of their order books is from the demand from the Range Rover Sport, as well as the Defender, which are some of their high margin products. So the order book trajectory still remains strong. Talking about the brokerage note as well, JP Morgan has come out with a note where they maintain their outperform rating, overweight rating, I beg your pardon, with the target price of 925 rupees. They do say that JLR wholesales is seen to be improving, the mix remains strong, but the management commentary regarding the free cash flow as well as their debt reduction will be important during results. So that's the update coming in from Tata Motors JLR division. The free cash flow number will be a key to watch in the upcoming results.
All right, thanks very much. Sanjiv, why don't we get in your thoughts then, just going by the kind of updates that we've gotten from JLR as well as their commentary. It's been strong growth, although it has missed street estimates. And JP Morgan believes that there's strong profitability across JLR and the India business.
Well, that is why the price is at 800 Avan, and that is more than doubled. And on the back that JLR is not just China. In India itself, there is a big desire for Land Rover and the new version. But I think it's all in the price. I still think Ashok Leyland is my top pick in that sector. But and I would go with Maruti, which has come out with stellar numbers. But yes, Tata Motor is something we own. We are not increasing our size over here. In fact, we are reducing some of our weightage. But like we said, if China does make a comeback, which is very strong, and which, yesterday I was reading the China's central bank saying that they are going to use their reserve ratio very, very actively to revive credit. And that will be a blessing in disguise for, their consumption and some of the metals there. So buy on decline would be the strategy. But Tata Ashok Leyland will be the star for the next a few months in the four-wheeler space along with Maruti.
Right. Sanjiv, not that Zee has been an investment stock, has been at best a trader favorite, but now, news flow indicating and purely source-based, and that too on global wires, that the Sony merger is called off.
Well, like you said, Aisha, if and buts will keep going, because there is a lot of, you can imagine with 3% stake, the Goenkas have held the company, banks, institutions, everyone to ransom. And it's about time you went ahead with this. 96% is owned by institutions, shareholders, mutual funds, and Sony's infusion will be the big game changer. I am still keeping my fingers crossed. And MNC, once it becomes an MNC stock, this stock can be re-rated to, whatever levels you can imagine, 450, 500. Now, in the short run, there will be volatility. You will see, constant legal arguments on both sides of the coin. And if anything, TV channels will make money on both sides. So we will wait for the exact terms to come. I still think there will be some, arrangement when you've come so far. But I'm keeping my fingers crossed that it becomes an MNC. And sooner rather than later, we see the back of the Goenkas.
Okay, fair enough. Still keeping your fingers crossed when it comes to a Zee Entertainment. But that aside, let's also get in your outlook then, Sanjiv, on the entire earnings season. In terms of individual sectors, in particular, if we were to talk about IT, what exactly is it that you're penciling in, given the fact that the year gone by has been fairly muted for the IT basket as a whole?
So Avan, we know this is seasonally a weak quarter, and we expect that, but we would like the guidance. No, the yields which have fallen, inflation coming lower than what was expected, and US spending back. And yesterday, actually, it was NVIDIA which hit a new high. I mean, NVIDIA is $1 trillion. So, there is going to be this constant worry about AI and what impact. But if I saw anything to do with electrical manufacturing services and the correlation of outsourcing, I think Indian IT is here to stay. Now, what the guidance will be more important than the numbers. The numbers are discounted. We continue to like HCL Tech and Wipro and would use any decline to buy and Persistent and Coforge on the mid cap side. But like I said, it is the guidance going forward because what they look for the year will be the key since the US is already now pricing in a very, very soft landing on or a mild recession.
Okay, point taken. Sanjiv, stay with us. Lots more Q3 updates as well have trickled in since last evening. Sharad is here with a quick update. Sharad?
Well, in focus, we are having Metropolis Healthcare inline set of numbers coming in for Q3. When you look at it, the core business revenue, that has jumped 12% on a year-on-year basis. And of course, it has been aided by the volume growth. Now, interestingly, the segment of the premium wellness segment has actually done well in the third quarter itself. And the management had stated the margins did get impacted in the third quarter. This is coming in because of the operations being impacted in the situation in the Chennai and the Tamil Nadu front. But overall, it's largely in line to good set of numbers when it comes to Metropolis Healthcare. And going forward, our channel checks suggest that there would be price hikes also coming in as it will be competing against the digital players. The second stock in focus would be Bajaj Finserv, largely inline set of numbers. If you talk about the Bajaj Allianz General Insurance part, the gross direct premium, that has jumped 18% on a year-on-year basis, while it's been roughly flattish when it comes to its life insurance business. But it is largely in line. The third stock in focus would be IRB Infra. Good set of numbers coming in. The toll revenue, if you look at it for the December month, that has jumped up to 26% on a year-on-year basis, and the strong numbers have been coming in because of the macro data. And as per our channel checks, it's expected that in the fourth quarter there might be a toll revision as well. So do track Metropolis Healthcare and IRB Infra on their suggestive revisions going ahead.
All right, thanks very much, Sharad, for giving us those updates. Meantime, let's get in a take then on the charts of some of the stocks that have been in the spotlight in yesterday's trade. And just going by what we started off with, Kunal, the fact that some of the laggards included the likes of heavyweights like Reliance Industries and an HDFC Bank, along with an SBI in trade yesterday. What is the chart reading?
Well, many of these stocks yesterday, in fact, managed to break below their, multi-day, multi-week support for themselves. So, for example, Reliance Industries had, a support closer to 2,580 mark on the spot levels. Yesterday, the stock made a low of 2,568, which means it's managed to break below its key support point. HDFC Bank, particularly, that stock formed a bearish head and shoulder pattern on the daily charts, even though it's a contracted pattern of just about some 50-60 points. But because of the weightage of the stock on the Nifty, as well as the impact the stock has in terms of the sentiment, even a 3%, 4% drop could probably mean, a short-term knee-jerk reaction on the indices. So even that stock yesterday managed to break below the 1675 mark, which is the neckline of this of this bearish head and shoulder pattern for HDFC Bank. And I think the worry for the markets are not just these two large cap stocks underperforming, but even ICICI Bank, with the stock which has struggled over the last 2-3 weeks, particularly the stock from I think 1030 or 1050 odd levels is now sub the 1000 levels for itself. So the pattern of making consistent lower highs and lower lows for ICICI Bank is also adding salt to the injury for the markets as such in the near term trend. So we would have to wait out for a point where these stocks start to get into a reversal as well as a consistent bout of uptrend rather than this consolidative and a mixed trend for themselves.
Fair point. Bhasin साहब, good morning.
Morning, Nikunj.
कैसी ठंड है जी?
8 डिग्री है सर. बड़ा मुश्किल है सुबह सुबह ये करना, but that's part of life. It's just a मौसम. It doesn't last too long, but we take it as it comes. So I think this is the best time to be in Delhi. 8 degrees is what I'm sitting at right now.
Markets are also feeling chilly, sir. The momentum of last month has suddenly vanished.
Nikunj, that was bound to happen. I think mid caps can still undergo some more correction, and that is much needed. But large caps, on the basis of earnings, on the basis of macro, on the basis of bond inclusion, on the basis of foreign buying, will continue to be the ones So like we said, we are 65% now on large caps, and we continue to be very, very positive there. That is where the real, I think, value remains. Like I said, 21,500 has got defended twice. We should see 22,000 maybe in the next week, and we'll take it from there. Given that now a lot of consolidation in the US and overseas in India is about has taken place. So I still think it's the index, the large cap, which will move. Bank Nifty should be the one which should really charge things up, because their numbers will be very, very optimistic. I mean, bank earnings should be the best in this quarter.
Fair point. I want to look at this entire media space, and if one assumes, Bhasin Saab, that the Sony merger does not go through, it's an assumption. I don't have a confirmation. There is nothing on the exchanges. This is a pure global wires had reported this last evening and everybody picked it up. If the merger does not go through, what could be the immediate downside for Zee as a stock?
So see, Nikunj, I think Zee will find some other person or some other group which will want stake over there. And definitely, like I said, with 3% stake, the Goenkas can't hold the company to ransom for how long. I am very sure there will be another buyer who will come there. But yes, in the short run, there will be negativity more created because of the rumor mongering which is going on. I still think, given that 2 years deadline has passed, there will be some sort of agreement where they will get this, and most suitable seems Puneet Goenka takes a bow and remains on the board and gets a certain fee for, guiding the people through. But they don't want him to be at the leadership. So we'll wait for the news. But yes, you could see a sharp downturn in the sense 25%, 20% maybe, because smart money is going to use this decline to buy, since the underlying asset is extremely viable for any other person who wants to make an India entry.
Another stock which is worth revisiting because of the block deal yesterday, Nooresh, is GMR Airports. And, everybody's flying. Airports are busy. New planes are getting added. New destinations are getting added. Do you think GMR Airport, Nooresh, could be one of those stocks which, according to that Nooresh Mirani theory, 10 साल के consolidation के बाहर निकला? इसकी नई theory, इसको हम नई theory बोलते हैं बसीन साहब. And I love this point on, look at stocks which essentially are breaking out after 5 to 10 years of consolidation. Nooresh, you should get it copyrighted. I shamelessly use it every time.
I think this is a classical style for technical analyst, so nothing to copyright as such, but something which should be copied by most people and implemented. So GMR Airports, the problem is the fact that it has already moved up 50% from the time it broke out. So I recommended the stock around those 60 levels, and then suddenly out of nowhere, we saw the deals happen and it has gone into momentum. The volumes have increased. Now, in such a case, when stocks have broken out after a long period of consolidation, the only way you can ride them is to keep a trailing stop loss at the last swing lows or at the 20-day moving average. So in this case, that stop comes a little lower, but even now, if one wants a stop loss a little closer, it will come closer to 80 levels. So yes, the stock is already up quite a bit, and the only way to ride is to keep a trailing stop loss at current levels to buy. The risk reward may not be great.
Okay, fair enough. That's the view coming in on some of those buzzers in trade. Meantime, let's get in your thoughts then on the OMC, Sanjiv. Just owing by the way that we've seen the overall crude oil prices trend, and it seems like a lot of analysts are of the view that there's a valuation upside basis the consolidated earnings and the investments in some of the listed peers. How are you looking at this basket, which has already rallied?
Yes, Awan, before that, I'll just like to remind Nikunj that JP Power, when I came to your studio on 15th September, I recommended at 8.5, and I said buy it and forget it. It has hit 17.5 yesterday. JP at 11 rupees is now 24, and we know the story of Vodafone. So yes, sometimes if you have the real valuation metrics on the market cap, on the scenario, you can make multi-baggers. GMR is something which I've been chasing and recommending from 35. I still think Awan OMCs are a buy, a screaming buy, given that their, the Russian episode has played out very, very well for them. They refine both soft and hard crude, and numbers from particularly IOC, HPCL will be stunning. So we have an overweight on IOC out of all the three, HPCL, we are not chasing it because it's gone up very, very fast. But I think this is a very, very good space which has just started. You know, if Nooresh can concur with that. I mean, years of consolidation, but 240 HPCL is suddenly 440 and 90 rupees IOC is 130. I still think there is room on the upside. And there are very good classical play of the business, which is doing extremely well.
Okay, that's OMCs for you in trade. Meantime, Nooresh, let's get in a chart check going then on some of these buzzers in yesterday's trade. You had something like a Chalet Hotels, which rallied pretty smartly, and BEML as well was on the upside.
So, Chalet Hotels has been a slow and steady uptrend, and that's been the case with majority of the hotels over the last 2 years. We've seen a slow and steady trend out here. So, Chalet continues to look positive. Would expect the next move towards 750 odd levels. So, looking at these stocks more from a buy on dips category rather than looking at it current levels.
Sanjiv, good to have you on board. Thanks so much for taking time out and joining in. Let's also welcome on board then Deven Choksey, who's joining in on the show. Deven, good to have you. It's been a pretty momentous year when we look at the real estate space. Just yesterday, DLS saying that they're selling flats worth 7,200 crore rupees. What is it that you're looking at within the entire real estate space? Is the party going to continue?
Yeah, good morning, Avan. Well, if you look at the macro space, I think you would find that out of the total savings and investment of the as a percentage of GDP, you find about 60% of that money goes towards buying real estate and gold, and balance 40% goes into the financial assets. Now, that means that if the GDP is going to increase, then the rally for real estate will continue, and also for gold to continue eventually. That is how I think one can simply summarize, given the kind of data that you have. On the other side, with more amount of money in the hands of the consumer, he is going to first buy houses and bigger houses. And that is where probably I think money is being spent today at this point of time in metros and even in ACT, BCTs as well. So from that perspective too, I think the demand scenario likely to remain robust. The third most important point, I think, which could come in favor of real estate going forward would be the gradual reduction in the rates of interest. I think, which probably I think would be showing the first signs somewhere in the end of calendar year 24, wherein you will probably find that the central bank has started talking about reducing the rate of interest. Given that situation, I think the demand boom is expected to continue in the real estate space, and including I think for most of the consumer discretionary spending. So from that perspective, I think one should remain bullish. Now, the second point is about the market and the pricing. I guess I think the market has already factored in FY26 earnings, I think, for most of the real estate companies, which means I think we are running far more ahead, I think, as far as the outlook on the earning is concerned. And that is an area where one will have to be a little bit watchful about, because for some reason, if the market trips at this point of time, it does not look like, but for some reason, if it trips, then possibility of I think the downside would be there in this stock, and that is the time when you could possibly enter into some of the real estate counters. But as of now, the safer bet would be to stay with the NBFC companies who are funding the real estate.
Let's talk about specifics of Bajaj Auto for a minute in terms of the buyback. It's not a big buyback. It may be at a premium, but it is not a very big buyback. So if you're a retail investor, Deven Bhai, you're not going to get any big money or anything big in terms of if you tender your shares.
And I think you are spot on. It's a 4,000 crore and a market cap of 2 lakh crores, so which is 2%. So frankly speaking, out of your portfolio, I think you're only going to get 2% of the shares. Theoretically, I think you're going to get 2% of your shares accepted under the buyback. And that's where probably I think is all game about. I don't think that I think this is going to create any major difference. In fact, those who have remained invested in Bajaj Auto, for them, I think it is a good, convincing story. Largely because of the fact that the company has always been distributing dividend, which is again equal to 2% yield. So for sure, I think this company has rewarded investors handsomely by way of dividend, by way of buybacks. I think they keep on distributing cash because yearly they generate around 7 to 8,000 crores worth of cash. In the balance sheet today, they have got about 23,000 crores of cash. And as per the rule, basically they have said anything above 15,000 crore cash held in the balance sheet they would distribute 70% out of it. So I think if you are counting it, then possibly this 4,000 crore of the buyback is the first lot that they're distributing. The second lot would be by way of dividend going forward. So for investors, I think it's a money-making machine for sure because I think cash is coming back into the books. But otherwise, you are absolutely right. I think this buyback is not something that one would get excited about. Buy shares at current level from the market, which is 40% cheaper than yesterday's price, and get the money out of it because that is not going to be the proposition. Maybe the stock price will go up in the interim period for sure, given the kind of 10,000 crore market they've set. But that's okay. I think that is for the traders to make money at this point of time.
Stay with us, Deven. Let's put the spotlight on Chambal Fertilizers, the company in the spotlight as they are looking to buy back up to 1.5 crore equity shares, or about 3.7% of the total paid up equity share capital at a price of 450 rupees a share. Abhay Baijal is the MD of Chambal Fertilizers, now joining us on the show. Thank you for taking time out, Mr. Baijal. 700 crore rupee buyback. What is the rationale? If you could walk us through that.
The rationale behind the buyback is that we have been a dividend-paying company from the very beginning. And it was felt that something needs to be a little bit done for our shareholders. And this was, after examining many options, this was felt to be the best way to reward them. We have almost completed more than, I would say, 25 years, and there hasn't been ever either a bonus or a special additional dividend. So this was a long-standing demand of many investors, including institutional investors, and looking to our overall financial position, which was felt that this is the proper time to do it.
How has the decline in the Rabi sowing impacted performance for Chambal?
We say that there was a slight delay in plantation, but that has now been made up, and we haven't seen really very much of an impact in the region that we operate in due to reservoir levels. No doubt they have been a little lower than normally what they are, but this is par for the course. If you see past 10-15 years, this is not so much of an issue. A good monsoon will make it up, unless and until the governments decide in some states to reduce the water for irrigation. Then it becomes a cause for concern. But so far, we have not seen any indication of that type.
Right. And, what is the impact when it comes to the urea production as well and pricing? Can we say that the second half will be better than the first?
Now, for all plants has been on par, optimal, with the full capacities. There is no deficiency there in this quarter, and we don't see anything going forward which is out of our budgeted numbers. As far as the pricing is concerned, you know that urea is a controlled commodity in terms of the maximum retail price which can be charged to the farmers. So there isn't very much deviation on that side. Insofar as the cost of production is concerned, that is taken care by the formulae that the government applies in terms of urea production. So to that extent, we have not seen any deviations, and the flow of subsidy bills that we have raised has so far been quite satisfactory, and therefore we are comfortable with our liquidity.
Now, the industry and expectations from what are your expectations from the upcoming budget?
We have made certain representations on taxation, especially indirect taxation. GST, for instance, is a big issue for the industry because of a negative carry due to the fact that the output costs, on which the base on which the subsidy, the base on which the GST is applied is normally lower than the inputs. And is specifically much more blatant, or I would say important in the case of non-urea fertilizers, bulk fertilizers, especially the other grades, P and K grades, phosphatic and potassic grades. So this is a long-standing demand that we have with the government that this may be corrected. We understand that there have been many meetings on this issue and the Council of GST. There were one or two dissenting voices, which is why this was not got through. But hopefully the government will take decisions which will be for the benefit of the industry, because this is purely a industry-related issue due to the fact that the government gives the subsidy. That is why there is a inverted duty structure because of the base shift. That is one of our major demands. Apart from that, we also hope that the government make adequate allocation for subsidy for the next year, that is 24-25.
Your capex plans in specific, what kind of cost-saving measures you have targeted?
See, I will tackle Gadepan 1 and 2 first. There are 3 plants in position in Chambal at our Gadepan site. As you know, we are the largest single-site manufacturer of urea in the country and possibly the world. I'll have to check because we are doing almost 3.5 million tons at one site. Now, Gadepan 1 and 2 ongoing energy efficiency projects are on, and they are absorbing of the order of almost 150 to 170 crores in terms of capital expenditure. They are likely to yield benefit in terms of efficiency improvements, in terms of how much lower energy consumption there would be per ton of urea produced. As far as Gadepan 3 plant is concerned, there are studies at hand which we have to, and these are very expensive studies, by the way, because these are done by the licensor, process licensors and the experts and consultants. So, in case something of value develops there, definitely that will be told to the investing public. And we are sure that some of the other normal benefits start accruing after 4 or 5 years of running the plant, because sufficient data has been generated under various conditions, which is what they use as a database to design some new improvements and so on. So, having run the plant now for almost 4.5 years, enough data has been generated on the basis of which further thought process on improving of process can happen.
Well, I appreciate your time, and very thank you for joining us. Let's turn our attention to what is happening to HDFC Bank. And Nooresh, Kunal, Deven bhai, the most popular consensus buy on the street is Reliance. Second most popular consensus is HDFC Bank. But does not matter whether FIs are buying or DIs are buying, both these stocks are just stuck. 1% change for Reliance in 1 year, and for HDFC Bank, I think it will be a flat year with absolutely no returns also. Let's look at HDFC Bank last 1 year. You know, the graphic is also taking time to load up now because everybody's forgotten it. Okay, Nooresh, when will this consensus buy become more like a reality?
So HDFC Bank has been a consensus buy forever, but the price has been at the same zone. So if we go back, even in September, October 2021, the stock that's the first time it touched 1700. Then again in the merger announcement, etc. So it's very clear till the time we don't cross those levels of 1700, 1750, the momentum doesn't start. It has been 4 years. We've been pretty range bound for the stock. But the more attempts it takes at 1700, 1750 indicates that there is a possibility it can break out. As of now, we have again started reverting from those areas. So once it crosses, yes, that's the time I would start looking at it again. For now, it's too early to look at it because it's been a relatively very sideways stock compared to everything in the market. Same is the case with Reliance Industries, but relatively Reliance has done better because it has at least gone up a bit over the last highs of 2020-21, and you need to add Geo to it. But again, adjusting for it, 2600, 2650 remains the major resistance. So the fact is, a major momentum in the markets, in the index can come once these two stocks take out those prices. As of now, Reliance looks more interesting. That could be the first one to actually break out.
देवन भाई, सबका समय आता है. इन दोनों शेयर का समय कब आएगा?
So let's look at it from a fundamental point of view first, and then probably I can look at how exactly these possibilities can be made available, I think, in the marketplace. Many times we have seen that the companies, they for years they don't do anything as far as the stock price is concerned, and thereafter they end up giving you appreciation in weeks. Well, I think in case of HDFC Bank as well as in Reliance, if carefully we study the pattern of how exactly the business is growing, every 4 years I think the balance sheet is getting doubled. Now this is something which is phenomenal because I think this kind of growth engine on such a large balance sheet is extraordinary as far as I think the investors' wealth creation aspect is concerned. Another aspect to look at in case of Reliance in particular, they have always moved, I think, once in 4 years. So suppose if they moved in 2020-21 financial year, I guess I think the time will be now for the stock to move up. Why it is once in a 4 year? Interesting pattern to study because every time I think this company takes money from investors and puts money into the capital expansion. After 4 years, the project gets completed and thereafter the reward time starts for this company. But till the time capex gets over, I guess I think the company is underperforming as far as the stock price is concerned. And that is the time when investors normally end up accumulating this stock to get this kind of return. We are seeing this possibility even this time around when the renewables getting started in 24-25, and that is where probably I think the first time you will see the signs of getting some values unlocking at some point of time. Along with that, I think the other businesses are continuing. The Geo platform business is continuing. The retail business is continuing. Both of them are growing at a steady pace of around 20%. So that is equally, I think, interesting to observe. In my viewpoint, maybe it's worth a wait if we are going to get the return out of it in one single year after waiting for 3 years.
There's one stock which I'm going to throw it open and anyone can pick it up. Nooresh, Kunal, Deven bhai. Trident. Trident yesterday was one of the most traded stock on National Stock Exchange. Imagine the stock actually traded more than JP Power, GMR. There was a block deal, but the stock did exceptionally well. One day change 18%. The company is in the business of making terry towels. It is a textile company. I don't track the financials that closely, so I'm going to reserve my comments there. But cotton prices I know for sure have come down. And globally, this entire chain seems to be coming back again in terms of the demand coming from US retailers. Now with that little introduction to the company, who wants to take the conversation forward? Deven bhai, Kunal, Nooresh? अरे भाई कोई तो बोलो, मेरे को इतना ही पता है इसके बारे में.
So well, I'm not
अब सब बोल
having a
रहे हैं.
complete coverage.
हाँ जी बोलिए बोलिए.
I'm not having a complete coverage on this company, but at the macro picture level, we look at this particular business very carefully. And as you rightly said at the end, I think the US retailers have started, I think, once again with more confidence in 2024 likely to be. That is where probably you are going to see higher demand for Indian textiles and Indian textile products. In fact, the government is so determined to encourage the textile and the textile mega parks along with that many of the strong players are likely to play a significantly large role that we are understanding. In our interaction with many of the textile players, we find that some of the specialty players, like the one which we are talking about in the product segment, they are relatively having better times ahead because of the margin that they are commanding or the premium that they are commanding for the products in the marketplace. So though I don't have the full coverage on this particular company, but in general, I believe that I think some of the specialty textiles companies, the products that they're manufacturing, including in the upholstery segment, including in the sports segment, I believe that I think these are some of the companies which are likely to see relatively higher amount of margin and the growth going forward. But maybe I'll reserve my comment for Trident at some other point of time when I look into the financials.
Okay, that's the take coming in on Trident. A lot of auto stocks as well are going to be in focus, especially Tata Motors, Bajaj Auto after that buyback. Tata Motors, JLR has managed to deliver the highest wholesale number in about 11 quarters during Q3, which is an uptick of about a good 27% on a year-on-year basis. Tata Motors already sitting at 800 levels as a stock. For Eicher Motors as well, Royal Enfield has signed an MOU to invest 3,000 crore rupees in the state of Tamil Nadu. So that's going to be another stock which is going to be in focus. There's Metropolis Health as well. The Q3 core business revenues have come in higher by 12%, volume growth at 9%, and that's better than what the street was penciling in. So these are a bunch of stocks which should be reacting positively to the news flow on them. Zee, of course, thankfully in an F&O ban. Otherwise, don't know what would have happened to Zee. In fact, we should bring up that stock price as well for you. Early days yet, but yeah, already you're seeing a gap down on that stock. Considering, wire agencies are reporting and purely saw space that Sony is set to be planning to call off that $10 billion merger with Zee. That's Zee in trade for you right now. Quite the mystery, right, Zee? Don't know what's going to head with this one.
Yeah, I mean, see, it's been over 3 years now, Aisha, and the deal's not gone through, whatever may be
Big
the
drag.
reason. Yeah, whatever may be the reason. And you know that this deal, in a sense, now could pivot Zee and the Sony franchise to a different level. And if the merger does not go through, given that how the dynamics of the entire news industry and the media industry have changed, globally there is consolidation happening, locally there is consolidation happening. It's a completely different landscape when it comes to the India entertainment, OTT stroke the movie production industry. Now a lot was hinging from a trader standpoint and from the near-term standpoint in the fact that the deal will go through. Now, interestingly, we don't have official news, communication, denial, or any kind of a indication from Zee or from Sony. When we reached out to both the managements, we've not got any reply back. So, market today are also reacting to what is called as source-based news. But bear in mind, Zee is heck of a volatile stock. It has got this huge bump up in volumes. It keeps on moving in and out of F&O. So in the near term, given that nothing has gone through in terms of the merger going through, deadlines after deadlines, nothing has gone through, and globally wires are reporting it, the market reaction today really could be harsh. Until and unless we get a formal denial or a communication from Zee or from the Sony management that the deal is still on and they're still talking to each other, I think in the near term it's fair to assume that the nervousness in the stock will remain. Kunal?
Absolutely, yes. And that's one of the major reasons why we've also avoided Zee, recommending even buying, when the stock was on the verge of a breakout about 280, even on dips or on correction, because you have to be, stocks become, more favored in terms of trading, investing when they're out of such kind of a major overhang in terms of news flow. And till the time that is not clear, it becomes very, very difficult to try and trade these kind of names, even though, they may be at a point where the technical structure may look attractive in terms of risk reward or in terms of a breakout.
We'll thank Deven on that note. Deven, good to have you on the show as always. We'll let you go. Let's also just quickly mark what the pre-open rates have settled in at. 0.5% higher, 400 points up in the green for the Sensex, about 100 odd points up in the green for the Nifty. But amidst that, let's get in some mid-cap trading ideas as well. Nooresh, let's start off with your list.
So continue to be bullish on Motilal Oswal Financial Services. We've seen good trend across the whole broking and financial space. Relatively over the long term, Motilal has been an underperformer, but finally the stock has broken out above the highs of 1200, which were last made in 2021. Then consolidated for a couple of months, and a fresh breakout has taken place in the last two sessions. So expecting this to continue towards 1500 plus levels, stop loss at 1250.
Okay, Kunal, what about your mid-cap ideas?
Well, that would be a buy on DCB Bank. The stock even yesterday on such a kind of a market closed on a positive note. It made a new swing high above 160-61 levels for itself. So we'll go ahead with a buy on DCB Bank. Targets of 170, stop loss at 155.
Well, and where's Bajaj Auto? The buyback comes at a fat premium of about 40%. Where's the stock? 10% higher, 76.82. Abhishek Gaushinde joins us, Deputy Vice President Research at Sharekhan PNB Paribas. All right, Abhishek, good morning. Thank you for joining us. The buyback is at a very fat premium to yesterday's closing price. But if I look at the quantum of the buyback, it's 4,000 crore for a company which has a market cap of 2 lakh crore. That translates into less than 2% equity. Do you think market should get excited, or it's time to just ignore and move on?
More than that, it is right that the offer size is relatively small to the market cap of roughly 4,000 crore. But what is important is that they are this time they are coming out with a tender offer route, and in which they are giving a premium to the current yesterday's current price of roughly 40%. And second thing is that this buyback offer is coming during the up cycle of the business comes. Previously, when open offer came, it was at the down cycle, down cycle. So broadly, we believe that it is not from the fundamental perspective, given that the extinguish of a 2% kind of equity would not have a material impact on the ROE. but the kind of confidence which the promoters have been or the company has been placed on to its stock price or its valuation to the stock price, that is key point to note it down is and buyback offer. And second thing is that although given the large size of the retail investors and the small size of this share buyback offer, the acceptance ratio is likely to be low for the new shareholders, but for the existing long-term shareholders will have an opportunity to participate in this tender offer, even though this acceptance ratio will be low.
So Abhishek, what's the revised price target in Bajaj Auto? Already a gap up on the stock. And, you know, the day that they announced that they're going to be mulling a buyback as well, the stock has been on a tizzy ever since.
Definitely, Bajaj Auto has been our topic in the two-wheeler pack with the Hero MotoCorp, given that we have been more positive on the mass market players compared to the existing premium players. And definitely that maybe the screen is not in front of me, but I can assume that the stock price may have reached our target price, and we will revisit our earning estimates and target price after the Q3 results.
400 right now on Bajaj Auto, already indicating a gap up of 10%, Abhishek, in the pre-open rates. But good having you on the show. Thanks for taking the time out and joining in. Let's just mark some of the other buzzers as well in trade and what's going to be holding out and what's actually pulling up. Sharad, in fact, is here before that to tell us what's the cover on D Street and what are the stocks that he's picking buzz on. Sharad?
Focus is Valiant Organics, and the buzz in the street is that textile chemical orders have started picking up in the month of January. Now, it's expected that the larger inquiries would be coming in the fourth quarter and a large order would be coming in when it comes to the dyes and the textile intermediate segment. Now, looking at the overall contribution coming from the textile chemical, that stands at roughly 8 to 10% of the consolidated basis of the total revenue of the company. But do remember that the stock itself has been range bound over the last 6 months. Also, we are having channel checks in the textile segment, and of course recently concluded Bangladesh election, there is still an issue of wage revision pertaining, and because of that it might be advantage to the Indian exporters in the apparel segment. Apart from this, also there has been strong technical moves coming in over the last 2 trading sessions when it comes to the textile stocks, so do keep this in the radar.
Lots lined up on today's show, stocks as well that will be reacting. But for now, let's get in those mid-cap trading calls and index calls rather from our chartists and find out what their advice is. It's a consensus no trade call from both Kunal as well as Nooresh. Remember, in yesterday's trading day as well, we did see a bit of pressure kick in for the frontline indices. Let's find out what the advice is when it comes to the Nifty Bank Index as well. A no trade call from both Kunal as well as Nooresh.
Long deal on Zee, while the stock, of course, has gapped down in the pre-open rates itself, but more than 17 lakh shares have already traded. And remember, today the stock is in an F&O ban. Had it not been the case, I don't know what would have happened to Zee from here on. But that said, lots of other stocks also which are going to be in focus. Let's see what IRB Infrastructure is doing. The toll collections have seen a rise of 26%. BEML, which has won orders worth about 393 odd crore rupees. There's, of course, Metropolis as well, wherein the core business revenue has actually seen a fair amount of growth. That stock is as well is holding higher. And Bajaj Auto, like we mentioned, that, of course, has gapped up in any case. A lot of other names too. There's Cipla, the JV in US, has actually, got a call for cell therapy products. So look out for what Cipla as well does in trade. I want to see what Bandhan Bank as well is up to, because there's a lot of news flow around. Remember, yesterday the stock cracked hard, was down about almost, I think, 6% or so. And today it's seeing a rebound of about 3%. But let's see what the blue chips are up to. What are the big drag points from yesterday doing? What's SBI, ICICI Bank, HDFC Bank? Are they seeing a reversal or not and pulling their weight up? 633 on SBI, that's a green tick. Not a meaningful comeback from ICICI Bank by any standards. And HDFC Bank has done nothing, just mildly in the green as we speak right now. Kunal, ICICI Bank, and to your mind, that was the key problem area yesterday, right? The way ICICI Bank and, for that matter, SBI as well fell. What are the charts reading from here besides today's rebound?
So I think SBI is still a stock which is into an uptrend. The stock, I think, made a fresh high above that 650, 660 mark and has now gone through a mild downtrend. But then I think it's come back towards the support of 618, 620 on the spot level. So I think closer to that point is a good buying zone for SBI. The concern for ICICI Bank is the stock underperforming, showing signs of negativity. And then whenever you see signs of weakness on the Bank Nifty or on the Nifty broadly, you've actually seen ICICI Bank underperforming the benchmark indices, or maybe getting in line with the times when the markets gets into a corrective phases. The formation of lower highs and lower lows also is one of the concerns for the stock on the near term. Breaking below the 1000 mark, which is a psychological support, and we've seen historically that stocks, when they break psychological support, take a lot of time to try and make a comeback. So we'll have to wait out for a point when ICICI Bank makes a comeback about the 1000 levels. That could probably be one of the key, I would say, highlights in terms of the stock making a comeback. But I think as of now, looks like that the stock would underperform.
Okay, just about 2 minutes to go for the market open today, and let's get in a take then from you, Nooresh, as to what the outlook is on heavyweight Reliance Industries after yesterday's underperformance. Is there a sense that we're likely to see more consolidation as the markets as well are in a range?
Looks like a consolidation, but testing the upper band of the last few years. So if we go back for the last 1 year, 2550 to 2650 has been a resistance. Adjusting it for Geo as well. Now, over the last 2 weeks, if you notice, we've made 3-4 tops around those 2630 mark. We've come very close to it, almost gave a breakout. On both the days, it has taken a hit from those levels. 2500 remains a support. So for now, it's a consolidation, but once it crosses 2630, 2650, that would be a clean breakout and would create more upsides toward 2800 to 3000. So watching out for the stock to see follow-up price action. The structure remains positive.
Coming in on Reliance Industries. Meantime, in terms of the trade setup today, remember you do have a pretty positive handover coming in. In particular, a lot of those tech stocks rallied in trade overnight. You had the Asian markets as well that held out quite smartly, the likes of Nvidia, etc. And you had the Nasdaq as well, which was at an all-time high. This morning, the Asian screen as well seems to be following that same trajectory. You also have a lot of the inflation data as well that's going to come out from the rest of Asia. You've got the treasury yield at about 4% and the US dollar index at about 102.2 levels. But Aisha, just about 10 seconds to go for the market open today.
Yeah, absolutely. Gearing up for a rebound after that breach of 12,500 that we had in trade yesterday. Today, given what the GIFT Nifty as well as the global support is looking like, it seems like it's going to be a green day. Of course, we'll get you more reports and perhaps get a report of honor on Bandhan Bank's clarification too. 0.6% higher. We've made it back to the 21,600 print. In fact, inching closer to 21,650 as we speak right now. What's Bajaj Auto up to? They've announced the buyback worth about 4,000 crore rupees, significant premium to the current market price. But at the same time, the quantum of the buyback is not something that the street was anticipating, or smaller than what one would thought have come out. Bajaj Auto still holding higher by 4.5% as we speak right now. Bandhan Bank, by the way, is holding up about almost 2.5%. We'll shortly be getting our reporter as well and get in more details on this. There has been a clarification set out by Bandhan Bank and the stock clearly is reacting to that. Besides that, IRB Infrastructure, Tata Motors wherein the JLR wholesales volumes have seen a shoot up of about 27%. IRB Infrastructure toll collections have risen 26%. BEML after that near about 400 crore rupees order wins. That stock as well is going to come up for you on your screens, 2.5% of a move. There's Metropolis Healthcare as well. Core revenue business growth has been quite decent. And now I want to see Zee because reports are indicating that the merger is likely to be called off with Sony. That stock has gapped down about 9% as we speak. What are the heavyweights up to? Reliance, HDFC Bank, ICICI Bank, SBI, they will come up for you on your screens next. Reliance hovering around the 2600 level. ICICI Bank as well has made a rebound. Still flat for HDFC Bank. Refuses to budge around 1665 odd levels right now. And SBI, which fell 2.5% in yesterday's weakness, that stock as well will come up for you on your screens. 1% higher for SBI as we speak. Aman, anything that you're spotting?
Well, for now, it continues to remain a fairly decent start, so no complaints whatsoever within the broader universe as well. You've got traction building up, in fact, a degree of outperformance for the mid and the small caps. While, of course, your usual suspects are under pressure, the likes of Zee Entertainment on the flip side, Lemon Tree Hotels continues its up move, HPCL looking smart, IRB Infra in the green, and something like an India Bulls Real Estate, along with IT stocks like Wipro, Infi, First Source, InfoEdge. That entire basket is a buzz in trade. A smart